The second quarter of this year has been quite a challenging period for Australian commercial property markets. From a macroeconomic perspective, the numbers look fairly strong. The Australian economy grew in the first quarter by 1.3% or 4.3% annually. The key drivers of growth were investment spending particularly around the mining sector, and also exports. The other category that was quite strong was consumption expenditure, although that requires some qualifications. It seems that Australian households are spending up quite aggressively on services, but not specifically on the kind of retail items that one tends to buy in shopping centres. Given the patchwork performance of the Australian economy, as well as global volatility across financial markets, it has to be said that the Australian commercial office market performed quite strongly during the second quarter. We saw net absorption of 74,000 square metres across CBD markets, which in fact is above the 10-year average, although vacancy did drift out from 7.2 to 7.8%, which largely reflects the completion of a number of major projects during the quarter. In the current volatile market, it's important to watch sublease space availability. Sublease is important because it provides a very sensitive and very quick indicator of changes in tenant demand. During the second quarter, we saw a slight uptick in sublease space across many of the markets, although in the Sydney market, which we would expect to be particularly sensitive to financial market volatility, we saw sublease space come down slightly. Going forward, we expect vacancy to remain across most markets in the 7 to 8% region. It's important that there's very little in the supply pipeline, and the low level of supply will support low levels of vacancy over the next few years. Specifically in Sydney, through 2012, we expect to see no completions at all, and this is the first time since 1970 that this has been the case for the Sydney CBD market. Moving from the office market to retail, it has to be said that the retail sector has been encountering a number of headwinds. Retail turnover has been fairly weak, in fact since 2008, and a number of factors are at work here. First of all, household savings rates are quite high. Secondly, we're seeing a shift, possibly a long-term shift, towards online purchasing. And thirdly, we've seen the entry of a number of offshore retailers, which is making the sector more competitive. Going forward, we expect that the retail sector will encounter easier trading conditions through the latter part of 2012 and into 2013. Household balance sheets are being rebuilt, interest rates have been cut quite sharply by the Reserve Bank, and there is some evidence that house prices are stabilising and starting to rise. As this happens, the household balance sheet will become a lot more relaxed, and we expect that consumers will be willing to spend more freely than they have over the last 2 to 3 years. The industrial sector has bounced back quite strongly from the downturn, although it has to be said that in the second quarter we did see a slowdown in activity. Leasing activity was slow, rental growth was flat, and a number of tenants postponed making decisions about future growth. Against that backdrop, though, investment activity has been quite strong, and we know that a number of investors, both domestic and offshore, continue to show strong interest in acquiring assets in the sector. Secondly, the supply-demand equation is favourable in most markets. Demand grows, albeit more slowly than previously, but the construction pipeline is very low in most markets, and that will support vacancy and support rental growth going forward. Thirdly, yields have stabilised, and relative to bond rates, they remain relatively high. The yield spread in Australia, for example, is much wider than in most other markets, and this provides a degree of comfort for investors in the event of any market correction. Yields for prime assets in Australia remain relatively high by global standards, and it's also important that the yield spread, the spread between the yields and real bond rates, is close to record levels. This applies in all sectors, and for example in the chart, you can see that the yield spread for the prime industrial sector is also close to record highs. This means that a lot of bad news is potentially priced into the market. Were there to be a correction, or were bond yields to move back up towards normal levels, investors have a high degree of comfort that asset values will be supported. Finally, in the second quarter, a number of trends which are likely to be of long-term significance were re-emphasised. For example, in office markets, we saw increased interest in activity-based working. In the case of the retail sector, increased focus on online retailing. All of these trends are likely to be of significance to the office market, to retail, and also to industrial markets over the next few years.